Hi everyone, me again. This is the second video in the series where I am taking a look at the financial statements of banks. In this video, I suppose what I'd like to explore is how the markets work in the context of bank financial statements. And again, just to bear in mind that this is quite an oversimplification of reality, but sometimes it helps to, because it's very easy to get caught up in the details. So I hope this will maybe explain how the money markets interact and how this impacts on the financial statements of a bank. I will use the same set of financial statements that we finished up with in the last video, but you needn't necessarily have seen the previous video to be able to engage with this particular one. So what I'll do is I'll share my screen and you'll be able to see what one or two sets of financial statements. Let me just do this here, and we should be good then. Now, here we are. Okay, so hopefully you can see now the financial statements of two banks in front of you, both here in Excel. The one over here on the right-hand side, which is Bank for All. These are very innovative names, but on the left-hand side, it's Bank for All. And this is where we finished up with this particular bank. We've got some cash of 2.7545 million, some loans, property, and you can see we're at 11.17 million. And likewise, on the other side, we've got some liabilities back out to our customers for their deposit accounts. They're not necessarily the same people, by the way, so that's another 10 million back out to our depositors, and 1,170,000 is the investors' equity. We then have a second bank on the right-hand side, which is Bank for Everyone, and they have a very similar kind of balance sheet. Obviously, the numbers are slightly different, but they're two separate entities. And we're going to maybe walk through a kind of a set of scenarios to kind of maybe help explain how the money markets work. And I'm going to need a little bit of extra space to be able to do that, so I'll just create it down here, and I'll maybe write my details up over here of the different details of the different transactions. So let's just start out then in the first instance with we're going to look at the Bank for Everyone, and let's just imagine that the Bank for Everyone is a customer who they've agreed to give a loan to for €1 million to buy a house. Okay, so let's have a look at how that might look, and then we'll see how it plays out and how the kind of the overall system might fit together. So in Bank for Everyone, first up, bank customer of Bank for Everyone is given a loan. And just to keep the numbers easy, now we're not too worried about any mortgage or the mortgage regulation and how much somebody can get on a mortgage and so on. And also you'll see that immediately the bank's cash will fall to zero. We're not really yet, we won't concern ourselves too much with the regulations on that side of the house either. But the customer of Bank for Everyone is given a £1 million loan to buy a house. The second part is we'll try and deal with some of these together, is that this individual buys a house, customer of Bank for Everyone, gives the cash to the customer of Bank for All to buy the house. So effectively, what's happening here is that a customer of one bank is using the money that they've been given as a loan to give the money to a customer of another bank, and then that bank, for the customer of that bank, for the moment at least anyway, the customer of Bank for All puts the money on deposits. So that's a fact. So I think we're now at a point where we can probably model how this might look in our financial statements. We're not there's a bit more to this, but let's start off and just say customer of the bank, the customer who gets the loan. Okay, so this is the customer who gets the loan. I just need to widen this guy out, and maybe I might narrow this guy in just so that we can see everything here. So this particular individual, they're going to get the loan, and the impact that that's going to have is that it's going to change our financial statements ever so slightly. We are effectively now converting what was in our cash, so that's going to be going down by 1 million, and we're going to put that money, or we're going to give that money out as a loan, which means that our loans become now 9 million, and everything else. I need to get another zero in there, and everything else then pretty much stays the same. So we still have our property and so on and so forth, and we will still have our customer accounts, and we'll still have our investors' equity. And obviously, like there'll be interest on this, so forth, but it's going to take time. This is all happening over the space of one day. It's going to take time for that interest to accrue up to the bank, and we'll then have an income. I'm just going to rebalance my financial statements, and I'm just going to make things look a little bit better here by just completing that. So after this particular customer is being provided with the money, our cash that we have on hand diminishes down to zero, and our loans to our customers goes up to 9 million. We've got no change to our property, no change to our deposit accounts, because this is a loan transaction on this side, and then the investor's equity stays the same as well too. Over on this side, then we have got a customer deposit. So this is the customer on the other side. And the money effectively then what happens is that the money comes into our cash account. So where we previously had 2 million, we've now got an extra amount of cash. We have not changed our loans out to our customers. Our property transactions remain the same, but our customer accounts that were at 10 million are now going to go up to 11 million. If I can just put an extra zero in there. There we go. 11 million, and our investors' equity remains the same, because obviously we'll be paying interest out on this deposit account, but we're all within the same day again here. I'm just going to tidy things up now a little bit, and we'll do this and this, and I'll copy this guy down. And I also then need to rebalance my financial statements, and they should still be in balance. Okay, so I now have got 12 million worth of total assets, 12,170,000, and 12,170,000 of liabilities and investors' equity. So that's where we stand at the minute. Now, I suppose at this point in time, then the Bank for Everyone, which is the bank on the right-hand side, they're looking at their cash and they're thinking, gosh, we're looking a little bit tight on cash. That's not great in case one of our depositors is looking for their money back. And the Bank for All on the left-hand side, they're thinking, gosh, we've got a lot of cash sitting here that is not really doing a huge amount for us, and maybe we could get a little bit of an extra return on it. So it's so I suppose and I guess the money markets don't work this simplistically, but effectively what we're looking at doing is we're looking at maybe Bank for All lending money to Bank for Everyone for a very short period of time. The money markets typically, the money is lent could be for a overnight, it could be for a week, it could be for a month, or for any random period of time, up to about, well, it depends on kind of what regulations you're looking at, but about 270 days, I think off the top of my head, is 9 months is kind of, once you go beyond that, then you're starting to move outside what would be the typical money market terms. So what would happen then in this situation is that we'll go for 4, Bank for All, they look to place 1 million on the money markets, and Bank for Everyone, they take the 1 million. Okay, so essentially then what this means is that after this particular transaction, I'll just pop this up here, the money market transaction. Now these would be usually how would I describe it? They'd be standardized contracts, so there wouldn't be a major lift to get them put into place. And I'll go down and I'll just make everything look a little bit better here. So what would happen after this transaction is that this effectively are 1 million. Now we're taking our 1 million back out, and we are going to effectively transfer that money over to Bank for Everyone. Our loans to customers remain the same, and our property remains the same. And we also have another asset. It's our money market asset, certificate deposit, whatever it might be, however we want to, whatever kind of contractual arrangement we're using to give this effect. And that's going to be 1 million. And we'll sum those guys up. And you can see it comes to the same kind of number. And I'll just tidy this up. Our customer accounts, they remain the same. They're still 11 million. Our equity is the same, and they add up to the same number. So bank one is in equilibrium, or is balancing up. I suppose equilibrium is probably the wrong word to use. So here we now have the money market transaction done for Bank for All. Now that money gets transferred over to Bank for Everyone. So I'll just put that here, and I'll put this over here. So the impact of this is that the Bank for Everyone is now going to be sitting on 1 million worth of cash. And there'll be no change to the loans to customers. That was the previous transaction. No change to property. I'll add them all up, and I'm now looking at 10.5 million. No change to my customer accounts, but I do have a money market liability. Put that in the wrong place. Which is back to, that money is owed back to Bank for All. And we're at 1 million there. And my investors' equity is 1 million. And if I add them all up, it all comes to 10.5 million, and everything looks as if it's back up in balance again. So you can see that how this is kind of this particular set of transactions, and as money moves around the system, how this particular set of transactions look from the perspective of the financial statements in two separate banks, depending on whether you're the bank that's received the money from the person who sold the house and then maybe transferred it back into the interbank system again, and or vice versa. I suppose the issues here from a kind of a, I suppose, a systemic level is that we, for example, Bank for Everyone, let's just look at their side of the house. They have lent out an extra €1 million on a mortgage, which would be seen to be quite long-term lending. And they have, I suppose, for all intents and purposes, replaced it with a shorter term liability. Okay, so that is essentially, that's a timing mismatch in so far as on one side your liabilities, which can be quite short term, could be a week, a month, 6 months. Yet on the other side, you have got a loan to customers, which could be for 25 years. Now that's a kind of, that's a fundamental kind of part of the banking system, and inevitably, it does involve a certain element of risk, but it's up to the individual banks to manage that kind of level of risk, and there's a lot of regulation around how that can be done. So that's one, I suppose, feature of this kind of transaction. This was something, I suppose, that we learned, or that we learned to our cost in the 2008 financial 8, 9, 10, 11, 12 financial crisis, because I guess what happened around that time was that after a while, counterparties were a little bit nervous. The people who had lent into Bank for Everyone, I guess, were nervous that these loans to customers were not necessarily what they thought they were. In other words, they were not completely confident that the 9 million loans to customers was an accurate reflection of what those loans were likely to realize. And as a result, then this short-term source of funding dried up for the banking system. It's called a credit crunch. It was how I suppose that was what it was called at the time. But effectively, the banks that were borrowing short term were no longer able to get that short term money anymore. That's a certain, that's one of the downsides of this. The upside of this, I guess, is that because you do these transactions relatively quickly, and you do them maybe daily, weekly, or whatever, any additional risk that you take on should be reflected in the price of the debt that you've just acquired. So, for example, if there's a little bit, if the interest rates have gone up, or if you're as a bank, if Bank for Everyone is suddenly perceived to be more risky, then this money market liability, the rate that they'll be charged will start to tick up. And that will then put a brake on their ability to lend money to customers. Because if if you find that this particular money market liability, because it was 2%, and now you've got to pay 2.5% because you're perceived to be a little bit riskier, well, then your margin gets squeezed. And it might get squeezed to such an extent that you might end up you might, I suppose, moderate your lending into the marketplace. But that's, I suppose, the kind of the levers that can be used to keep the banking system working effectively. And the benefit of this kind of short-term conversion is that interest rates and risk gets priced very quickly into the banking system, rather than being something that might take, otherwise it could take weeks, months, and years for it to filter all the way through. Okay, so I mean, I guess the real issue here is just so that you can see how the transactions have kind of impacted on, as we've gone from our starting position, our first transaction, and then our second transaction, and how that gets, I suppose, impacted in the financial statements of a bank. At this level, it's relatively at this very high level anyway, I guess, at least it's very easy to see how it all works. But then again, once you get into the detail, and the difficulty here is, it looked like here that this was a straight transfer from Bank for All to Bank for Everyone, but in reality, you have umpteen banks all kind of doing their transactions on a daily basis. Some banks are receiving money. They've got to, if this was a transaction and the customer of Bank for Everyone, and they were the two customers were in the same bank, well, then that would reduce the need to do this kind of money market transaction. So like when you do have umpteen banks then in the market, it gets a little bit more convoluted and a bit more complex. Anyway, I'm going to leave it there. I'm not going to rattle on for any more. I hope you got something out of this, and we can, when we do meet up, we can chat through some of these particular transactions later. Thank you very much, and see you the next time.